I need you to sit down. I need you to take a breath. And I need you to understand that what happened over the last 72 hours was not an accident. It was not a glitch. It was not the market doing what markets do. What happened was a precisely timed, surgically executed wealth transfer from your pocket to theirs. And if you are sitting there right now feeling sick to your stomach because you watched your portfolio get obliterated, if you are questioning everything you thought you knew about precious metals, if you are wondering whether you made a terrible mistake, I need you to stay with me. Because by the end of this video, you are going to understand exactly what happened, why it happened, and most importantly, what is coming next. Ladies and gentlemen, Mr. AG here, your Asian guy, and it is February 2nd, 2026. The dust is still settling, the bodies are still being counted, and the mainstream financial media is already spinning the narrative, telling you that this was just normal market behavior, just some profit taking, just a healthy correction after an incredible run. Do not believe them. What we just witnessed was the worst single-day crash in gold since 1983. Let me say that again so it sinks in. The worst day for gold in over 40 years. Silver just had its biggest daily drop in recorded history. And you want me to believe this is just the market finding equilibrium? You want me to believe this is just supply and demand doing its thing? No. What we witnessed was a coordinated attack on precious metals holders, and I am going to prove it to you. Let me take you back to January 29th, 2026, just a few days ago. Then came January 30th, and everything changed. Gold dropped 9.8% in a single session. Nearly 10% gone in one day. That is not a correction. That is not profit-taking. That is a controlled demolition. Silver got hit even harder, dropping so fast and so hard that it triggered circuit breakers around the world. In India, the MCX silver contract crashed 15% in a matter of hours. Silver ETFs in India hit 20% lower circuit. 20% lower circuit. That means trading was halted because the selling was so extreme that the exchange literally could not handle it. The Kotak silver ETF, the Tata silver ETF, the Edelweiss silver ETF, all of them slammed into the floor so hard that the market had to pause and catch its breath. But here is the part that should make your blood boil. Here is the part that separates the people who understand how this game works from the people who are just pawns on the chessboard. This crash did not happen in a vacuum. This crash was triggered. And the trigger was pulled by the CME group. On January 30th, the exact same day that precious metals were in freefall, the CME announced that they were raising margin requirements on gold and silver futures. They raised gold margins from 6% to 8%. They raised silver margins from 11% to 15%. And they said these changes would take effect after market close on Monday. Now, if you do not understand what margin requirements mean, let me explain it in simple terms. Margin is the amount of money you have to put up to hold a futures position. It is like a down payment. When the CME raises margin requirements, it means that every single trader holding a leveraged position suddenly needs to come up with more cash. And if they cannot come up with the cash, they have to sell. They have to liquidate. They have no choice. So picture this. Gold is already crashing. Silver is already crashing. Panic is spreading. Traders are already underwater. And right at that moment, the CME comes out and says, by the way, you now need to put up even more money to hold your positions. What do you think happens? Mass liquidation? Forced selling? A cascade of margin calls that feeds on itself and pushes prices lower and lower and lower. The CME did not cause the crash, but they poured gasoline on the fire at the exact moment it would do the most damage. And you need to ask yourself a question. Why? Why would the CME raise margin requirements at the worst possible moment? Why would they make it harder to hold precious metals positions right when those positions were already collapsing? Is it because they care about market stability? Is it because they want to protect traders from themselves? Or is it because someone, somewhere, wanted this crash to happen? Someone wanted weak hands to be shaken out. Someone wanted leveraged longs to be liquidated. Someone wanted the price to be pushed down as hard and as fast as possible. I do not believe in coincidences. I believe in incentives. And the incentive structure here is crystal clear. The CME makes money on volume. The CME makes money on volatility. And the big players, the bullion banks, the hedge funds, the institutions with deep pockets and inside information, they make money when the little guy panics and sells at the bottom. They are not trying to protect you. They are trying to take from you. Let me give you the numbers so you understand the scale of destruction we are talking about. Gold has lost about $900 per ounce since that all-time high on January 29th. $900 gone in the blink of an eye. As of today, MCX gold is down 19% from its record high. 19%. Silver is even worse. Spot silver has shed 33% since its peak last week. MCX silver is down 38% from its record high. 38%. That is not a correction. That is a massacre. That is wealth being vaporized, being transferred, being stolen in broad daylight while the media tells you it is just market forces at work. But here is what they do not want you to see. Here is what they are hoping you are too panicked to notice. Even after this historic crash, even after the worst week in precious metals in over 4 decades, even after everything they threw at the market, gold is still up 108% year over year. Silver is still up 268% year over year. Let me repeat that. Silver, after a 38% crash from the highs, is still up 268% compared to where it was a year ago. Does that sound like a bubble that has popped? Does that sound like a market that is topped out for good? Or does that sound like a secular bull market that just experienced a violent shakeout designed to reset the board? I need you to understand the psychology of what just happened. Because this is not just about numbers on a screen. This is about human emotion. This is about fear and greed and the way markets are designed to exploit both. For the past year, precious metals have been in a historic rally. People who got in early made life-changing money. People who got in later saw their accounts growing every single day. And a lot of those people got comfortable. They got leveraged. They got greedy. They thought the train would never stop. And then the train went off a cliff. The purpose of a shakeout like this is simple. It is to make you doubt. It is to make you question everything. It is to make you feel so much pain that you sell at the worst possible moment and swear off precious metals forever. The big money needs you to sell. They need to buy your metal at depressed prices so they can ride the next leg higher. That is how wealth gets transferred from weak hands to strong hands. That is how the game has been played for centuries. Now let me talk about the other elephant in the room. Let me talk about Kevin Warsh. Because this crash did not just happen because of margin requirements. It happened because of a fundamental shift in the power structure of the United States financial system. On January 30th, the same day as the crash, it was announced that President Donald Trump had selected Kevin Warsh to be the new chairman of the Federal Reserve, replacing Jerome Powell. And if you do not know who Kevin Warsh is, you need to pay attention. Because this man is going to reshape the financial landscape of the Western world. Kevin Warsh is a hawk. He is a hard money guy. He believes in strong dollar policy. He believes in raising interest rates to crush inflation. He is the opposite of the easy money, print forever approach that has dominated the Fed for the past 2 decades. And the market knows what this means. It means higher rates. It means a stronger dollar. It means that the conditions that have been fueling the precious metals rally, low real rates and a weakening dollar, are about to change. When the market heard that Warsh was going to be the new Fed chair, it immediately started pricing in a different future. The dollar strengthened, bond yields moved, and gold, which hates high real interest rates and a strong dollar, got crushed. This is not conspiracy. This is not manipulation in the traditional sense. This is the market reacting to a genuine shift in policy expectations. But here's the question you need to ask yourself. Was the timing of this announcement a coincidence? Was it a coincidence that this news dropped on the exact same day that the CME raised margins? Was it a coincidence that both of these events happened right after precious metals had made new all-time highs? In the world of finance, there are no coincidences at this level. There are only plans. And the plan, as far as I can tell, was to deliver a 1-2 punch that would break the back of the precious metals rally. Punch number 1, the Warsh announcement to shift sentiment. Punch number 2, the margin hike to force liquidation. Together, they created the perfect storm. Together, they created the worst crash in 40 years. But here is where it gets interesting. Here is where we need to look beyond the immediate carnage and think about what comes next. Because the people who panic sold at the bottom, the people who got liquidated on margin calls, the people who swore they would never touch gold or silver again, those people are going to miss what is coming. And what is coming could be the biggest move in precious metals history. Let me explain why. First, let us talk about the fundamentals that have not changed. The United States government is still $36 trillion in debt. The interest payments on that debt are still consuming an ever larger share of the federal budget. The BRICS nations are still de-dollarizing. Central banks around the world are still buying gold at a record pace. The geopolitical tensions that have been driving safe haven demand have not gone away. None of the structural factors that caused gold to go from $4,800 to $5,500 in the first place have been resolved. All that happened is the price got reset lower, creating a new buying opportunity for those with the stomach to take it. Second, let us talk about the technical damage. Yes, the charts look ugly right now. Yes, momentum has been broken. Yes, there's going to be resistance on the way back up. But look at the recovery that is already happening. Today, February 2nd, gold futures are trading 2.8% higher. Silver has bounced 5% off its lows. The ETFs that hit 20% lower circuit are recovering, up as much as 10% from their worst levels. The market is not dead, it is wounded, but it is already starting to heal. This tells me that the selling was exhaustion, not genuine conviction. The weak hands have been washed out. The leveraged longs have been liquidated. And now the strong hands are stepping in to buy the dip. Third, let us talk about what a 38% drawdown actually means in the context of a bull market. If you study the history of precious metals, you will find that violent corrections are not the exception. They are the rule. In the great gold bull market of the 1970s, there were multiple corrections of 30%, 40%, even 50%. Each time, people said the bull market was over. Each time, the price eventually went higher. In the silver bull market that took the price from $4 to $50 in 2011, there were corrections along the way that wiped out half the gains. Each time, the weak hands sold and the strong hands bought. That is how bull markets work. They climb a wall of worry, and they shake out the uncommitted at every opportunity. So what should you do right now? What is the play for someone watching this video who is wondering whether they should cut their losses, hold on, or buy more? Let me give you my honest assessment. If you are holding physical metal, if you own coins and bars that are sitting in your safe, do nothing. Do absolutely nothing. You did not lose anything because you did not sell anything. The paper price went down, but you still have the same amount of gold and silver you had before. The purpose of holding physical metal is to protect yourself against exactly this kind of volatility. It is insurance. You do not cancel your insurance policy because the house did not burn down. You keep it because you know that one day you might need it. If you are holding paper positions, ETFs, mining stocks, futures, the calculus is more complicated. You have to assess your own risk tolerance and your own time horizon. If you are leveraged and you cannot meet the new margin requirements, you may have no choice but to reduce your position size. There is no shame in that. Living to fight another day is more important than being right. But if you have the capital, if you have the conviction, and if you understand what is happening on a fundamental level, this correction is a gift. It is an opportunity to add to your position at prices that we may never see again. Let me tell you what the smart money is doing right now. They are not panicking. They are not selling. They are accumulating. Every single ounce that gets liquidated by a margin called retail trader gets scooped up by an institution or a central bank that understands the long game. The Chinese are buying. The Russians are buying. The Indians are buying. The Saudis are buying. Do you think they are panicking about a 38% correction? Do you think they are doubting the value of gold and silver because the CME raised margin requirements? No, they are licking their chops. They are thanking the market for giving them a better entry price. And this brings me to the most important lesson of this entire episode. The paper market is not your friend. The futures market, the ETF market, the synthetic derivative market, all of these instruments exist for one purpose: to give the big players the ability to control the price. When the CME raises margin requirements, they are not trying to help you. They are trying to flush you out. When the price drops 10% in a day, it is not because the fundamental value of gold suddenly changed. It is because the paper market is being used as a weapon against physical holders. The only way to protect yourself from this manipulation is to hold metal outside the system. Physical gold and silver in your own possession cannot be margin called. It cannot be liquidated. It cannot be halted for circuit breakers. It just sits there, inert, unchanging, waiting for the day when the paper market finally breaks and the physical market becomes the only market that matters. We got a preview of that possibility this weekend. We saw spreads blow out between paper prices and physical prices. We saw delivery becoming difficult. We saw the first cracks in the facade. They managed to paper over those cracks this time. They managed to stabilize the system, at least for now. But each crisis makes the system weaker. Each shakeout forces more metal out of weak hands and into strong hands. Each margin call transfers more wealth from the west to the east. The end game is coming. It may not be this month. It may not be this year, but it is coming. Now let me address something that I know a lot of you are feeling right now. You are feeling angry. You are feeling betrayed. You are feeling like the game is rigged and there is nothing you can do about it. And I want to validate that feeling because it is correct. The game is rigged. It is rigged in favor of the big players who have the capital, the information, and the political connections to move markets in their favor. But here's the thing. Knowing that the game is rigged is the first step to winning. Because once you understand the rules, once you understand how they manipulate the price, once you understand their playbook, you can position yourself to benefit from it instead of being victimized by it. They want you to sell at the bottom. Do not sell at the bottom. They want you to give up on precious metals forever. Do not give up. They want you to believe that the rally is over and it is time to go back to stocks and bonds. Do not believe them. The structural forces that are driving this bull market have not changed. If anything, they have intensified. The Kevin Warsh appointment might temporarily strengthen the dollar, but it will not solve the debt problem. It will not stop the de-dollarization. It will not make the geopolitical tensions disappear. All it will do is create a temporary headwind that resets the price and allows smart money to accumulate at lower levels. I want to share something with you that one of the analysts said in the aftermath of this crash. He said, and I quote, "The sharp fall in gold and silver ETFs looks scary on the screen, but it is more of a sentiment shock than a story breaker." I want you to really absorb that phrase. Sentiment shock. That is exactly what this was. The fundamentals did not change. The story did not change. What changed was the sentiment. People went from euphoric to terrified in the span of 48 hours. And that emotional swing is what created the crash. But emotions are temporary. Fundamentals are permanent. And when the emotions settle down, when the fear subsides, the fundamentals will reassert themselves. Another analyst said, and I quote, "For investors, this is not a moment for panic. Gold and silver are portfolio hedges, not trading bets. If your allocation is sensible, staying put makes sense. If anything, staggered buying during corrections works better than chasing rallies. Volatility hurts emotions, not long-term plans." This is wisdom. This is the voice of experience speaking. The people who have been through these cycles before know that the worst thing you can do is make decisions based on fear. The best thing you can do is stick to your plan, maintain your discipline, and use the volatility to your advantage. Let me give you a framework for thinking about this. Imagine you are a farmer. You plant seeds in the spring, you water them all summer, and you harvest in the fall. Now imagine that one day in July, there's a terrible storm. The rain beats down, the wind howls. Some of your crops are damaged. Do you rip up the entire field and start over? Do you declare that farming does not work and you're going to sell the land? No. You wait for the storm to pass, you assess the damage, you replant what was lost, and you continue with the harvest. Because you know that storms are part of farming. They are not the end of the story. They are just a chapter. This crash is a storm. It is a violent, destructive, emotionally devastating storm, but it is not the end of the story. The seeds are still in the ground. The fundamentals are still intact. The harvest is still coming. You just have to have the patience and the courage to wait it out. Now, I want to be clear about something. I'm not telling you that the bottom is in. I'm not telling you that prices cannot go lower from here. They absolutely can. The margin requirements just went up, and the effects of that will continue to ripple through the market in the days and weeks ahead. There may be more liquidations. There may be more forced selling. There may be another leg down before we see a sustained recovery. Nobody knows exactly where the bottom is going to be. Anyone who tells you they know is lying. What I am telling you is that the long-term trajectory has not changed. What I am telling you is that this is a buying opportunity for those with dry powder and strong conviction. What I am telling you is that the worst thing you can do is sell into panic and lock in your losses at the exact moment when the big players are loading up. So here is what I want you to do. First, take a breath. Seriously. Step away from the screen. Go for a walk. Hug your family. Get some perspective. The sun will rise tomorrow. The markets will open. Life will go on. Your portfolio is not your identity. Your net worth is not your worth as a human being. This too shall pass. Second, assess your actual situation. How much of your portfolio is in precious metals? Is it a sensible allocation, or did you get over-leveraged chasing the rally? If you are over-allocated, this might be a good time to rebalance. If you are under-allocated, this might be a good time to add. The answer depends on your personal circumstances, and nobody can tell you what is right for you. Third, think long-term. Where do you think gold and silver will be in 5 years? In 10 years? Do you think the debt is going to get smaller? Do you think the dollar is going to get stronger? Do you think central banks are going to stop buying gold? If the answer to those questions is no, then the answer to whether you should hold precious metals is yes. It really is that simple. Fourth, focus on physical. I have said it before, and I will say it again. If you cannot hold it, you do not own it. The paper market just showed you, in the most dramatic way possible, that it can be manipulated, liquidated, and reset at the push of a button. Physical metal cannot. It is the only true safe haven in a world of digital illusions. Let me leave you with one final thought. The people who got shaken out this week, the people who sold at the bottom, the people who swore off precious metals forever, they are going to regret it. Maybe not today, maybe not next week. But someday, probably sooner than they think, they are going to look back at this moment and realize that they gave up at the exact worst time. They are going to watch gold go to $6,000, $7,000, $10,000, and they are going to remember the day they sold at $4,700 because the CME raised margins and they got scared. Do not be that person. Be the person who held on. Be the person who bought the dip. Be the person who understood that the game is rigged but played it anyway because you knew the end game. Be the person who, years from now, looks back at February 2026 and says, that was the best buying opportunity of my lifetime and I took it. The shakeout is not over. The volatility is not over. The war between paper and physical, between East and West, between the old system and the new system, that war is just getting started. But I know which side I am on. And I know which side is going to win. This is Mr. AG, your Asian guy. The crash was not an accident. The margin hike was not a coincidence. And the bull market is not over. Stay strong, stay physical, stay ready.